All right, let's talk about the five stages of silver and why stage five will blow your mind. Look, I'm going to tell you something that's going to sound insane at first. There's a fifth stage happening in the silver market nobody's talking about. Not the analysts on CNBC, not the guys running billion-dollar hedge funds, not even the people who lived through 1980 when silver hit $50 an ounce and then crashed so hard it took 40 years to recover. And here's the thing that should make you pay attention. We've already gone through stages 1 through 4. Right now in December of 2025, we arguably have entered stage five. And if history has anything to teach us, stage five is going to make the Hunt brothers squeeze look like a practice round. But before I explain what stage five looks like and why it's inevitable, you need to understand that silver isn't just some shiny metal that people make jewelry out of. Silver is the most manipulated, most misunderstood, and most explosive commodity on the planet. And the setup we're seeing right now has never existed before in human history. Let me walk you through the prior four stages we've already completed. Because if you don't understand how we got here, you won't believe what's coming next. Stage one started in 1999. That's when silver was trading at $5 an ounce. $5. You could buy an ounce of silver for less than the cost of a sandwich. And everyone thought that was normal. Most companies were going bankrupt. Or, sorry, mining companies were going bankrupt. Nobody cared about precious metals. Gold was dead, silver was dead. But something started happening that year that changed everything. Central banks, which had been selling gold for 2 decades, suddenly stopped. The infamous Bank of England had just dumped half their gold reserves at the absolute bottom. That was $275 an ounce, the worst trade in financial history. And that was the signal that the bottom was in. Silver started climbing slowly at first, $6, $7, $8. Nobody noticed. But the smart money was accumulating. Even in 2003, silver was at $5.50. Still cheap, still ignored, but the stage was set. Stage two hit in 2008. The financial crisis, Lehman Brothers collapsed, Bear Stearns vanished, AIG got bailed out, and the Federal Reserve did something that had never been done before. They printed 4+ trillion to save the banking system. Silver went from $9 in November of 2008 to $49 by April 2011. 5 times move in 30 months. Everyone said it was a bubble. They said it was speculation. They said it was going to crash just like 1980. And you know what? They were right. It crashed hard. By 2015, silver was back to $14. The people who bought at the top lost 70% of their money. The mainstream media said silver was dead again. Another failed speculation, another bubble that popped. But here's what they missed. Stage two wasn't about the price going up. Stage two was about proving that when central banks print money, real assets respond. When you create trillions of dollars out of nothing, people flee into things that can't be printed, AKA commodity supercycle. And silver is the most responsive metal on earth. Stage three started in 2020, March 2020 to be specific. The world shut down, the economy stopped, and central banks around the world did something that made 2008 look like a warm up. They printed 18 trillion in 2 years. The Fed printed 5 trillion alone. That's more than they printed in the entire decade after 2008 in 2 years. And it wasn't just the Fed. Every major central bank on the planet opened the floodgates, money printing on a scale that had never happened in human history. Silver responded exactly like it did in stage two, except faster. and went from $12 in March 2020 to $30 by August 2020. A 2.5 times move in 5 months. But this time something different happened. This time retail investors got involved. Wall Street's bets, the Reddit group that made GameStop famous, turned their attention to silver. They started buying physical silver. They started buying SLV, the world's largest silver ETF. They crashed the websites of every major bullion dealer in America. You couldn't buy silver anywhere. Premiums over spot went to $10. People were paying $40 for silver that was trading at 28 on paper. The squeeze was on and then it stopped. The price pulled back. Not all the way, but enough to shake people out, enough to make it look like another failed attempt. But by late 2022, silver was back to $18. The media said the squeeze failed. They said retail gave up. They said it was over. But stage three wasn't about the squeeze. Stage three was about something much bigger. It proved that retail investors could move the silver market. For the first time in history, regular people demonstrated they had enough collective buying power to break the paper pricing system. Stage four came next. This is the stage nobody was talking about, but it's the most important one because stage four is about supply and demand fundamentals that cannot be manipulated away. Here are some facts. Global silver mine production peaked in 2016 at 900 million ounces. Right now, we're at 830 million ounces annually. Production is falling. Why? Because most silver comes as a byproduct of copper, lead, zinc mining. When these metals aren't profitable to mine, you don't get the silver either, and the easy deposits are depleted. Meanwhile, demand is exploding. Industrial demand for silver is at all-time highs. Solar panels use silver. Electric vehicles use silver. 5G infrastructure uses silver. Ammunition uses silver. There are 500 ounces of silver used in a Tomahawk missile. Every electronic device you own has silver in it. Industrial demand alone is consuming 600 million ounces per year. Then you have the investment demand. ETFs hold 700 million ounces. They've accumulated over 20 years, but it's still sitting in vaults, not available for industrial use. India and China are importing record amounts for jewelry and investment. Central banks in some countries are adding silver reserves. Do the math. 830 million ounces of production, 600 million ounces of industrial demand and investment demand on top of that. The market is in deficit. We're consuming more silver than we produce every single year for the last 5 years straight. And here's the kicker: above ground stockpiles are depleting. The COMEX, where silver futures trade, has 250 million ounces in registered inventory available for delivery. That sounds like a lot till you realize industrial demand alone would consume that in 5 months. Stage four was the setup. It's the stage where the fundamentals become impossible to ignore, where the paper market that's controlled silver prices for decades starts to crack, where the gap between paper silver and physical silver starts to widen into a chasm. In this stage, in the current stage now, potentially stage five, we saw the first glimpse of price setting in the East. China, India, and other future exchanges have silver prices much higher than COMEX and LBMA. Silver is trading around $58 currently. It's up from the 2020 lows, and it's surpassed the previous $50 highs of 1980 and 2011. Many think silver may be stuck here. Many think it's just going to trade sideways forever or crash back down. They're wrong because stage five is beginning. And stage five is going to be unlike anything we've ever seen. To understand what stage five looks like, you need to understand what happened in 1980 because everyone compares silver squeezes to the Hunt brothers, but almost nobody actually knows the real story. And the differences between 1980 and today are what makes stage five inevitable. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires. They inherited a fortune from their father, H.L. Hunt, who was one of the richest men in America. And in the 1970s, they decided to buy silver, a lot of silver. Their reasoning was simple. Inflation was out of control. The dollar had just been disconnected from gold in 1971. Oil prices were spiking. They believed paper currencies were going to collapse and precious metals were the only real money. So they started buying not just futures contracts, but also some physical silver. Actual bars delivered to warehouses in New York and Switzerland. By 1979, the Hunt brothers controlled 100 million ounces of physical silver. That was roughly half of all the silver available for delivery in the entire United States. The price responded. Silver was $6 an ounce in January 1979. By September, it hit $10. By December, it was 20. By January 1980, it peaked at $50. An 8-time move in 1 year. Everyone panicked. The Commodity Futures Trading Commission stepped in. The exchange changed the rules. They implemented silver rule 7, which restricted new long position. You could sell silver, but you couldn't buy it. They increased margin requirements. They made it financially impossible for the Hunts to hold their position since they were also leveraged in future contract and paper silver. And then they delivered the final blow. Volcker, the Fed chairman, raised interest rates to 20%. Borrowing money became so expensive that leverage positions collapsed. The Hunts were forced to liquidate. Silver crashed from $50 to $10 in 8 weeks, the fastest commodity crash in history. The Hunts lost billions. They declared bankruptcy. And for the next 40 years, every time silver started to rise, people would say, "Remember the Hunt brothers? It's going to crash just like 1980." But here's what nobody tells you. The Hunt brothers squeeze was a targeted attack by two billionaires using leverage in futures contracts. They controlled the market through paper positions backed by physical delivery. And when the rules changed, they couldn't hold on. Stage five is going to be completely different. Because stage five isn't two billionaires trying to corner the market. Stage five is millions of retail investors, hundreds of institutional funds, industrial users scrambling for supply, and a physical shortage that can't be papered over anymore. Let me show you the data that proves this. In 1980, global silver inventories were massive. Government stockpiles alone held billions of ounces. The U.S. strategic stockpile had been accumulating silver since World War II. India had enormous inventories. China had state reserves. When the Hunt brothers drove the price to $50, all that inventory came to market. Government sold. Individuals melted down silverware and jewelry. Supply flooded in, and the squeeze broke. Today, those inventories don't exist. The U.S. strategic stockpile is empty, sold off in the late 1990s and 2000s. India imports over the last 20 years have exceeded exports. That silver's gone, melted into jewelry and religious items that will never come back to the market. China went from a silver export to a massive importer. Their above ground stocks are depleting just like everyone else's. In 1980, there was no industrial demand. Silver was used in photography and some electronics, but that was it. When the price spiked, industrial users could cut back or substitute other metals. Today, industrial demand is structural. You cannot make a solar panel without silver. The highest, newest, most efficient solar panels use increasingly more silver. You cannot make an EV without silver. 5G infrastructure requires silver. There's no substitute at scale. When the price spikes, industrial users have to keep on buying or their entire supply chain shuts down. In 1980, there were no silver ETFs. If you wanted exposure to silver, you either bought physical or you traded futures. Today, SLV alone holds 500 million ounces. The Sprott fund, PSLV, holds another 150 million. Sprott Physical Silver Trust and various European ETFs, they all hold physical silver in vaults. That 700 million that's been removed from the market and isn't coming back unless prices go dramatically higher. In 1980, retail investors didn't exist as a coordinated force. The hunts were acting alone. Today, millions of retail investors are one Reddit post away from coordinated buying. We saw it again in 2021. We're seeing it again now. And next time it happens, there won't be enough physical silver to meet demand. In 1980, you could change the rules and break the squeeze because it was concentrated in two people. Today, the buying is distributed across millions of participants in dozens of countries. You can't change the rules on everyone simultaneously. You can't force millions of retail investors to sell. You can't shut down industrial demand. Stage five, this is the moment when the paper market breaks completely, when the gap between the price of silver on COMEX and the price of physical silver in your hand becomes so wide that the fiction can't be maintained anymore. Here's where it gets really interesting. Did we just see the first glitch in price happen on Black Friday in the COMEX exchange in Illinois on November 28, 2025? A somewhat holiday, slow day, low volumes. Ironically, just as the silver prices were spiking to new all time highs and threatening to overwhelm a normally low volume, quiet trading day, the COMEX's bulletproof Tier 1 data center had a 10-hour outage, stopping all trading. More like a needed break in trading to prevent an out of control super contango price problem in silver. Enough time to get the paper traded silver shorts a new plan of action. Today, the ETF data that we have gives us a window into what's happening in the physical silver market that nobody had in 1980. And what that data shows is that we're closer to losing control in this early stage five move than anyone realizes. Let's start with SLV, the iShares Silver Trust. It's the biggest silver ETF in the world, over 14 billion in assets. It's supposed to hold physical silver in vaults in London and elsewhere. One share of SLV equals 1 ounce of silver minus fees. In March 2020, when silver crashed to $12, SLV had 480 million ounces. Then retail started buying. By February 2021, SLV held 670 million ounces. That's 190 million ounces of physical silver that had to be purchased and delivered to vaults in 11 months. Think about that number, 190 million ounces. That's 23% of annual global mine production, purchased and delivered in less than a year. To put it in perspective, that's more silver than entire countries use in a decade. And here's the key: those 190 million ounces came from somewhere. They came from existing inventory, from refiners, from above ground stocks that were sitting in London vaults or Swiss banks. When SLV bought that silver, it removed it from the available supply permanently. Because here's the thing about ETFs: they don't sell. When people redeem shares, the ETFs can deliver cash or physical. Almost always they deliver cash. The silver stays in the vault. So 1 ounce going into an ETF, or sorry, once silver goes into an ETF, it is effectively leaving the market unless prices go back dramatically higher and the ETF liquidates. Now look at what happened next. In late 2021, silver prices pulled back. Silver started declining in holdings. By late 2022, SLV was down to 550 million ounces. It lost 120 million ounces. Everyone said this proved the squeeze failed. People were selling, demand was dropping, silver was dead again. But look at the other ETFs. Sprott Physical Silver Trust, PSLV, was growing. It went from 110 million ounces in early 2021 to 150 million by late 2022. People weren't selling silver. Also, some who are suspect of the record keeping of SLV, whereas PSLV guarantees their vaults hold the physical silver, they were moving from SLV to PSLV because they didn't trust SLV's storage or structure. Today's ETFs holding worldwide didn't drop. They stayed elevated around 700 million ounces. The silver that came into ETFs in 2020 and 2021 didn't leave. It just moved around between different funds. And here's the critical insight. Every time there's a price spike, more silver flows into ETFs and never comes back out. In 2008, 2011, ETFs accumulated 400 million ounces. In 2020, 21, they accumulated another 200 million. Every cycle, more silver gets locked up. Meanwhile, industrial demand keeps growing. In 2015, industrial demand was 480 million ounces. In 2020, it was 550 million. In 2024, it's 600 million. That's a 25% increase in less than a decade. Solar panel production alone is consuming 150 million ounces annually. Now that's up from 50 million in 2025. Every solar panel installed removes silver from circulation permanently. You don't recycle solar panels. They sit on roofs for 25 years. Then they go to landfills. That silver's gone. EVs are consuming another 60 million ounces annually. Every electric vehicle uses about 1 ounce of silver in its electrical system. Global EV production is ramping from 10 million vehicles in 2022 to a projected 30 million by 2030. That's going from 10 million ounces to 30 million ounces of annual demand just from cars. 5G infrastructure, medical devices, water purification, electronic manufacturing, ammunition, weapons. Every one of these sectors is growing and every one of them requires silver. Add it all up. 600 million ounces of industrial demand, 700 million locked in ETFs, and mine production of 830 million ounces. The math simply doesn't work. We're running a deficit and we're drawing down above ground stocks to make up the difference. The COMEX registered inventory tells you everything you need to know. In 2020, COMEX had 400 million ounces for delivery. Today, it's 250 million. That's a 37% decline in 4 years. At current rates of depletion, COMEX will be empty by 2028. What happens when COMEX runs out of silver? What happens when industrial users can't get deliveries? What happens when ETF buying spikes and there's no available inventory to purchase? That's now what lies ahead in our stage five. Stage five isn't just a price spike. Stage five is a complete breakdown of the paper pricing system that controls silver for decades. And once it breaks, it doesn't come back. Here's how the silver market works. Right now, the price of silver is determined on COMEX through a futures contract. Traders buy and sell paper contracts representing 5,000 ounces of silver. Most of these contracts never result in physical delivery. They're settled in cash. The paper market is 100 times larger than the physical market. The system works fine as long as physical supply is abundant. If someone demands delivery, COMEX can source the silver from inventories and deliver it. The paper price and the physical price stay aligned. But what happens when physical supply gets tight? What happens when ETFs try to buy 200 million ounces and there's only 100 million available? The paper price and the physical price diverge. Suddenly, you can buy a paper contract for $58 an ounce, But if you want physical silver delivered to your door, you're paying 70 or $80, whatever it takes to find someone willing to sell. We saw early signs of this in 2020 and 2021. Silver was trading at 25 on the COMEX, but dealers were charging 35 for physical coins, a $10 premium. That's a 40% gap between paper and physical. That's not supposed to happen in a functioning market. The gap eventually closed, but only because industrial demand slowed during COVID-19 and some inventory came back to market. But next time that inventory won't be there. Next time the gap won't close. Stage 5 is here, and that's when gaps become permanent. When physical silver trades at a massive premium to paper silver because there isn't enough physical to meet demand. And here's why it'll make 1980 look like a warm up. In 1980, the problem was two billionaires manipulating the market. The solution was to change the rules and force them to liquidate. Problem solved. Market returns to normal. In stage 5, the problem is fundamental supply and demand. You can't change the rules to create more silver. You can't force industrial users to stop buying. You can't prevent retail investors in 50 different countries from purchasing whatever they can find. As stage 5 progresses, governments are going to panic. They'll do what they always do: blame speculators, implement price controls, restrict exports, nationalize mines. Most of that's already started. None of it will work because the shortage is real. Industrial users will start hoarding. If you're a solar panel manufacturer and you can't get silver, your entire production line shuts down. So you start buying 6 months of inventory instead of 1 month, then 12 months. Every industrial user does the same thing, and suddenly the shortage gets worse. Retail investors will panic buy. The Reddit crowd, the preppers, the gold bugs, everyone who's been waiting for this will flood into the market. And suddenly the shortage gets worse, right? People will pay anything. So dealer premiums will spike to $20, then 30, then $50 over spot. People will pay anything to get physical silver because they know it's not coming back. ETFs will scramble to source metal. SLV will have redemption they can't meet. The Sprott Silver Trust will have buying they can't fulfill. Funds will bid against each other for whatever inventory exists, driving prices vertical. And through all of this, COMEX will try to maintain the fiction that silver is trading at whatever the paper price says. But nobody will care because you can't eat a futures contract. You can't make a solar panel out of a paper promise. The paper market will break. And when it does, the real price discovery begins. So when does this happen? What's the timeline? What does it actually look like when the system breaks? Well, here's what we do know. We're in deficit. We've been in deficit for 5 years. Above ground inventories are depleting. COMEX registered inventory has dropped 37% since 2020. At current rates, we're looking at a critically low inventory by late 2026 or early 2027. But that's assuming everything continues at current rates. The trigger for stage 5 getting worse isn't gradual depletion. The trigger is a sudden shock to supplier demand that breaks the system before it's ready. What could that shock be? There are several possibilities, and any one of them could light the fuse. First possibility, a major mine disruption. The top 10 silver mines in the world produce 200 million ounces annually. If one of these mines goes offline due to accident, political instability, regulatory shutdown, that's 20 million ounces supply that vanishes. In a tight market, that's enough to cause a scramble. Second possibility, industrial panic buying. If major solar manufacturers or EV producers get spooked about future supply, they start hoarding. One major company buying an extra 6 months of inventory means 50 million ounces comes off the market immediately. Other companies follow, and suddenly you have a supply crisis. Third possibility, another retail squeeze. Wall Street Bets or some other online community coordinates and decides to start buying again, but this time with more money and more conviction. In 2021, retail investors bought maybe 100 million ounces. Next time it could be 200 million or 300 million. How about a billionaire comes into the market and stands for delivery for some 400 million ounces or more? Comics doesn't have that much registered inventory anymore. Fourth possibility, geopolitical crisis. Tensions between major powers escalate. You'll see a flight to hard assets, silver, gold, commodities. Central banks might start accumulating silver the way they've been accumulating gold. That's hundreds of millions of ounces of new demand hitting a market that can't supply it. Fifth possibility, currency crisis. If confidence in the dollar or other major currencies collapse, precious metals will explode, not gradually overnight. In a currency crisis, people don't care about price. They only care about getting out of paper and something real. Any one of these triggers could hit tomorrow or next year or in 2027. We don't know the exact timing, but we know the setup is there. We know inventories are depleting. We know demand is growing. We know the system is fragile. When it hits, here's what the timeline looks like. Week one, something triggers a spike. Maybe it's a mine closure. Maybe it's a Reddit post that goes viral. Maybe it's a geopolitical event. Silver jumps from 58 to 70 in a few days. Dealer premiums spike to $15 over spot. Week two, industrial users start panic buying. They see the price spiking and inventories tightening, and they start securing supply. This adds another wave of demand. Silver hits $90. Mainstream media starts covering it. Retail FOMO kicks in. Week three, ETFs start having problems. SLV can't source enough metal to meet inflows. Sprott Physical Silver announces delays in delivering physical to new buyers. COMEX registered inventory drops below 100 million ounces. Whispers start that COMEX might not be able to deliver on contracts. Week four, the paper market breaks. The spread between physical and paper hits 30 plus an ounce. You can buy a futures contract at 60, let's say when it was there, but physical silver is trading at 90 in the dealer market. COMEX implements emergency measures. Maybe they force cash settlement. Maybe they halt trading. Either way, the fiction is exposed. Month two, total chaos. Governments start intervening. Export restrictions, price controls, emergency measures. None of it works because the shortage is global. Silver hits 110, then 150. People who have bought 30 at 30 have made 5 times their money. People who waited are paying 200 now for coins. Month three, the peak. Silver hits some absurd number. Maybe 200, maybe 300, maybe 350. It doesn't matter. The point is, it overshoots massively because there's no inventory to bring to market. Everyone wanted to sell already sold. Everyone holding is holding because they think it'll go higher. Then comes the crash, just like 1980. Hold on. But every spike ends in a crash. The weak hands who bought the top panic sell. Some inventory comes back to market. Prices drop 30%, then 40%. People who bought at 200 lose their shirt. But here's the critical difference. The post stage five price doesn't go back to $30. It doesn't go back to $50. That's the floor because the fundamental shortage hasn't been resolved. Mine production didn't increase. Industrial demand didn't disappear. ETFs still hold 700 million ounces. So maybe silver crashes from 200 to 100. Maybe it settles at 80 or 90. But the new floor is dramatically higher than the old ceiling because stage five permanently resets price discovery in the silver market. That's why stage five is different from 1980. In 1980, silver crashed back to single digits because the shortage was artificial. It was created by the hunts. When they were forced out, the shortage disappeared. Stage five shortage is real, it's structural, and it's not going away. The post stage five world is a world where silver trades at triple digit prices. That's what it takes to balance supply and demand. The people who position early in stage five will make generational wealth. The people who wait will pay top dollar and miss it entirely. To people who think it can happen because this time it'll be stopped like 1980, don't understand that you can't stop a fundamental supply crisis. This isn't speculation. This isn't conspiracy theory. This is basic math. We're consuming more than we produce. Inventories are depleting. The gap is widening. Stage five is where the math catches up with the market. The only question left are when does it start and will you be positioned before it does? Everything we've covered across these five parts leads to one unavoidable conclusion. Stage five moves are not just a possibility, it's a certainty. The only variable is timing. And if history has taught us anything, it's these things happen faster than anyone expects and hits harder than anyone prepares.